Welcome to the Deep Dive. We're your guides here at Talk Tickers, and today we're digging into Peabody's Q3 2025 earnings call.
Oh, right.
Definitely one of the more volatile releases we saw this quarter.
For sure.
So our mission today is pretty straightforward. Cut through that initial market noise and really analyze the core operational story and the strategic moves management is focused on.
Absolutely. And it was, a quarter with really conflicting signals hitting the market.
How so?
Well, if you just caught the pre-market headlines, it looked pretty pessimistic. The stock dropped significantly right after the release.
Okay.
And that was driven by, a big miss on the bottom line, the financial side. But at the same time, the actual operations looked remarkably strong. So you really have to look past the statutory accounting to grasp that divergence, strong execution versus this significant cleanup charge, which was basically non-recurring.
Okay, yeah, let's unpack that contradiction straight away. Let's hit the results snapshot.
Sounds good.
So revenue was actually a beat. Came in at $1,012.1 million. That's above the consensus estimate.
Right, which points to, decent pricing, decent volume, solid top line.
But then, like you said, you get to the bottom line.
And that's what caused the initial shock, I think. They reported a GAAP EPS loss of $0.58.
Okay, and the expectation?
Consensus was for a loss of only $0.14. So yeah, the significant miss.
Wow, that's a big difference. A $0.44 gap. What drove that?
It's almost entirely down to one single item.
Which was?
The $54 million acquisition termination charge.
Ah, right. From walking away from that Anglo-American deal.
Exactly. It was mostly related to bridge financing arrangements, professional fees, that sort of thing. And they absorbed it all in Q3.
Okay, so for you listening, it's really important to understand that analysts, they typically filter out these kinds of huge one-off charges.
Right. Which is why the stock reaction was so dramatic, initially down, then snapping back.
Makes sense.
Precisely. So while that statutory GAAP number, it looked pretty bad.
Yeah.
The underlying cash generation was actually quite robust.
Okay.
They reported $122 million in operating cash flow. They kept their cash position strong at $603.3 million.
And total liquidity?
Over $950 million. So plenty of cushion there.
So the market reacted first to the headline loss?
Yep. Stock down maybe 3-5% initially. But then, as management provided clarity, explained this was, the strategic cleanup cost. Analysts started looking through it. You saw a benchmark, for example, raise their price target to $32.
Okay.
And that operational confidence, that underlying strength, that fueled a really sharp rebound. The stock jumped over 15% in the days following.
Right.
So the takeaway is Q3 looked messy on paper, sure, but the operational story, that's clearly winning out in investors' minds now.
Okay. That definitely sets the stage for digging into that strategic story. And I guess we have to start with the cornerstone of their organic growth plan.
Yeah, the metallurgical coal platform.
Specifically the Centurion mine.
Centurion is absolutely critical. It's really the future of their met coal margin profile.
And the progress looks good.
Looks very good. The longwall production is on schedule. Actually, they're aiming for an accelerated start in February 2026.
Okay. And this isn't just a small addition, is it?
No, not at all. This is major. Centurion is expected to expand their shipments, get this, sevenfold in 2026.
Sevenfold, wow.
Yeah, reaching about 3.5 million tons.
That's significant growth. But what makes Centurion so special beyond just the volume?
Cost. Management projects. This will be their lowest cost met coal mine, period.
How are they managing that, especially, in today's inflationary environment?
Well, it comes down to a combination of things. Good resource quality, for one. Logistics play a big part. And they're leveraging, newer technology, optimized mine design. It's all geared towards maximizing recovery, reducing waste haulage, basically driving sustained lower costs. But the real financial punchline here, the thing to really watch, is what this does to their portfolio average realization.
Right.
Centurion's low costs are expected to boost their average met coal realization as a percentage of the benchmark price.
From where it is now.
From around the 70% mark currently up to approximately 80% in 2026.
A 10-point jump in realization percentage.
Exactly. That kind of margin expansion, just driven by one organic project, that's a material game changer for their long-term profitability, almost regardless of where the cycle is.
That is a huge potential uplift. And like you said, even before Centurion fully ramps up, the Q3 execution looked pretty solid operationally.
It did. We saw higher Powder River Basin PRB shipments.
Right.
Better than expected seaborne thermal volumes, too.
Yeah.
And importantly, they hit the lowest met coal costs they've reported in several years.
So clear operational discipline there. But we can't quite ignore that strategic cleanup issue entirely, can we?
No.
The Anglo-American overhang.
No, we can't. And that's an essential point to remember. While the $54 million charge was, a one-time accounting hit, the arbitration that Anglo-American initiated, that is still an ongoing legal overhang.
Okay. And management's take on that?
They sound highly confident in their legal position. They fully expect to get the remaining deposit back.
Yeah.
But the key issue is duration. This isn't getting resolved quickly.
Right. They mentioned it's expected to take years.
Years. And while those big non-recurring bridge financing costs are now absorbed, they still project ongoing legal defense costs. About $5 million per year was the estimate.
Is management maybe being a bit too quick to just dismiss that as a long-term administrative cost? I mean, is there any risk beyond that $5 million settlement risk? Have they provisioned for anything?
That's a really sharp question. And you're right. Management's tone was, well, maybe dismissive is fair. Almost offensive. They definitely framed that $5 million annual cost as just, business as usual legal defense, not as a provision for a potential settlement or loss.
And their confidence comes from?
Their belief that the original contract termination clauses are clearly in their favor.
So for you listening, the takeaway is?
The immediate financial pain, that big $54 million hit, that's done. It's in the past.
Right.
The long-term risk is mostly about, management bandwidth being tied up, the distraction of multi-year litigation. That kind of thing can always hold a valuation back a bit, even if they ultimately win the case.
Okay. So with the decks now mostly cleared from that M&A situation, let's look forward. Where's management focusing that future cash flow?
Right, the forward guidance.
And specifically, they seem to be positioning the domestic U.S. thermal market, surprisingly, maybe, as a growth engine now.
Yeah, it's quite a shift in narrative. And the U.S. thermal platform is delivering.
How so?
It's generated nearly $150 million in cash flow just year to date. And PRB shipments are up a solid 10% year over year.
Yeah.
And maybe most importantly, management tightened their full-year guidance favorably for the second quarter in a row.
So that's usually a strong signal, right? High confidence.
Exactly. Shows they feel good about demand.
And those PRB volumes specifically.
They're now anticipating them being about 3 million tons higher than they previously forecast, landing somewhere between 84 and 86 million tons for the full year. And critically, costs are being lowered again.
What are they guiding for Q4 costs?
Expected to hit that really competitive range of $11 to $11.50 per ton. Very efficient.
What's really interesting to me, though, is the why behind this thermal strength. Management's making some explicit connections now.
Yes. This is fascinating. They are directly linking their domestic thermal platform performance to these big secular tailwinds, like the AI data center thesis. They're pointing to rising U.S. electricity demand up 2% year over year and saying it's driven directly by these massive AI data center build-outs, plus increased manufacturing load growth.
So the narrative is shifting from coal is dying to
baseload power is absolutely critical. Exactly.
And it's not just about load growth, is it? There's a policy angle and this huge utilization gap they talked about.
Right. Management went into detail on the policy tailwinds. You've got 58 coal units representing something like 46 gigawatts of generation that have had their retirement dates pushed back, extended.
Okay.
Plus, you're seeing a federal royalty rate reduction, and there's an upcoming production tax credit potentially helping too.
And these policy moves, they're not happening in a vacuum.
No, absolutely not. They directly reflect this sort of high-stakes U.S. energy transition narrative playing out. Grid instability concerns, the urgent need for reliable 247 baseload power to support these massive, sustained data center loads.
It's forcing utilities to keep coal in the mix.
It seems that way. Forcing commitment. Now look at the simple math management shared about existing capacity.
You mean that startling utilization gap figure?
Exactly. U.S. coal plants, on average, ran at only 42% capacity in 2024.
That seems incredibly low.
It is. And Malcolm Roberts on the call pointed out that optimal utilization, like the industry saw back in, say, 2008, is actually around 72%.
Okay.
Now, if the grid needs stabilizing, and if those 46 gigawatts of extended capacity actually get utilized more effectively, closing that gap, just moving from 42% towards that 72% optimal rate, could add a stunning 250 million tons of annual thermal coal demand.
250 million tons?
Annually to the U.S. grid. And here's the kicker. without needing to build a single new power plant, just using existing assets better.
That projection seems, well, extremely ambitious. Is 72% utilization really realistic, given, ongoing regulatory pressures, environmental opposition? Is management maybe setting an unattainable goal just to excite the market?
That's the absolute critical question, isn't it? And look, if you were betting based on the old utility demand model, yeah, 72% might look like an exaggeration.
Right.
But the demands from AI, from new manufacturing, they're different. Data centers need power 24/7.
Yeah.
It has to be non-interruptible baseload.
Okay.
Renewables alone, at least right now, cannot consistently meet that specific kind of demand profile. So this isn't really an environmental argument they're making.
It's an energy reliability argument.
Exactly. Management is essentially betting that grid stability, national economic necessity, will ultimately trump some of those regulatory headwinds. That the sheer need for power will push utilization closer to that optimal range because, frankly, there might not be another immediately available solution for that much reliable capacity.
Interesting framing. Okay, before we jump into our trade idea segment, let's just quickly touch on the seaborne markets. Management seemed pretty bullish there, too.
They did. They suggested all three of their end markets, met coal, seaborne thermal, domestic thermal, could potentially see upside pricing pressure heading into 2026.
And their reasoning for met coal specifically?
Well, they view current benchmark prices, around $195 a ton, as being pretty near the low end of the historical cycle.
Okay.
And the forward curve for next year is already higher, sitting around $215 per ton.
And the optimism comes from?
Purely supply side pressure, really. Management estimates that maybe 15% of current global seaborne met coal production,
which is
about 45 million tons, is currently operating at an unsustainable level of revenue, just not making enough money at current prices.
So that suggests...
It suggests capital rationalization, mine closures. That stuff is basically inevitable, which in turn tightens supply and should create a pricing floor or even upside for the efficient survivors like Peabody expects to be.
Makes sense. Okay, and finally, maybe the most non-consensus part of the story here, this free option idea.
Yes, the rare earth elements, or REE.
What's the latest there?
This is the newest strategic priority they highlighted, and honestly, it feels like a potentially brilliant pivot.
Why brilliant?
Because they're leveraging their existing massive PRB platform, the mines, the equipment, the infrastructure, to potentially extract rare earth elements and other critical minerals found within the coal seams or overburden they're already moving. Preliminary data they shared indicates concentrations that are similar to, or maybe even better than, what some specialized REE peers are reporting.
And the unique value proposition is?
Scale and logistics. That's the key.
Explain that free option mechanic for us.
Right. So they are already mining the material that contains these elements. They already have the giant shovels, the haul trucks, the rail lines, the huge workforce in the Powder River Basin.
Got it.
They aren't planning to sink a whole new mine just for REs. The idea is to simply add processing capacity, probably at the back end, to extract these valuable minerals from the overburden or maybe the coal ash that they're handling anyway.
So the incremental cost is relatively low compared to starting from scratch.
That's the theory.
Right.
That's why they describe their activity as aggressive in pacing yet disciplined at approach. They're trying to move fast but leverage the existing footprint. It minimizes the upfront capital risk.
And they're also working with the government on this.
Yes, they explicitly mention that. They're in discussions with multiple departments within the Trump administration. Regarding potential funding, technology partnerships, that sort of thing.
So it positions Peabody not just as a coal company.
Potentially, yeah. Potentially as a strategic national security asset tied directly into the critical mineral supply chain, which is obviously a huge focus area for the U.S. government right now.
Okay, that brings us to our not financial advice segment. This is where we transition from the deep analysis and construct a high conviction, maybe even a little outrageous trade idea based purely on the information we've just discussed.
And let me jump in with a standard but crucial reminder. This is purely for entertainment and informational purposes. You absolutely must conduct your own research and due diligence before ever considering any investment.
Absolutely. Okay, what's the pitch today?
All right, my pitch today is pretty simple, actually. It's high conviction and definitely non-consensus. It is go long BTU based on the optionality of U.S. power generation growth and that critical mineral leverage.
Okay, long BTU. Tell us why you think the market is currently missing this potential upside.
Well, I think the current valuation is just completely anchored in the wrong things. It's stuck in looking at cyclical coal prices. It's still thinking about the recent M&A hiccups.
Right.
And it seems to be entirely ignoring the latent value, the potential locked up in those U.S. thermal assets especially.
So you're betting the domestic utility story is changing structurally?
Yes. Structurally changing due to AI demand, and also that Centurion isn't just another growth project. It's an immediate, significant margin upgrade for their met coal business.
Okay. Break down the thesis for the trade. What are the key factors?
I'd say it's built on three main pillars. First, the Centurion ramp-up in early 2026. That should really solidify their long-term position in higher margin met coal. That's the execution pillar.
Okay, pillar 1, Centurion execution. Pillar 2.
Pillar 2 is the rare earth elements thesis. That's the literal free option we talked about. If those concentrations are confirmed to be similar or better than specialized peers, and they leverage their existing infrastructure, that could be hugely valuable, especially tapping into that national security mandate for critical minerals.
All right. And the third pillar, you said it might be the most outrageous.
The third pillar is betting on that massive structural tailwind of U.S. energy reliability needs.
Meaning the utilization gap.
Exactly. That potential move in U.S. coal plant utilization from just 42% today back towards something closer to that optimal 72% level.
Okay.
If that shift actually happens, driven by AI and grid needs, it represents a structural increase in domestic coal demand that is absolutely not priced into the stock today.
So it's a non-consensus bet that U.S. national security and reliability mandates will basically override some of the short-term energy transition talk, just out of necessity to power the industrial and AI growth.
That's the core of the bet, yes. Necessity driving utilization.
Okay, interesting. What are the immediate catalysts then? What should someone watching this potential trade look for to see if it's playing out?
I'd watch for two main things in the near term. First, look for the year-end reports or updates specifically on the REE results,
Your kind of details.
the specific types of rare earths they're finding, and crucially, the verified concentration levels. That's what will help put a potential dollar value on that free option.
Okay, REE confirmation. And the second catalyst?
Watch the natural gas forward curve. Keep an eye on it. If natural gas prices continue to widen out, staying consistently above, say, $4 per MMBTU, that financially forces utilities to commit to the kind of long-term coal supply contracts needed to actually run those plants closer to that 72% capacity. It would be proof that the structural demand shift is real.
Got it.
So the value, in this view, isn't just in the coal they're selling today at today's prices. It's in the coal they could sell and the margins they could get if this whole domestic macro story plays out the way management is suggesting it might.
And that's a wrap on our deep dive into Peabody's Q3 2025 results. I think the core takeaway here is pretty clear. The company seems to be decisively transitioning.
Yeah, moving away from a period really defined by market cyclicality and cleaning up that M&A situation.
Right. And moving towards one focused squarely on organic growth, primarily through Centurion, and also really trying to capitalize on these unique U.S. energy and policy tailwinds, whether that's AI driving electricity demand or that national security focus on rare earth elements.
And that really leaves you, the listener, with an essential final question to maybe mull over.
What's that?
Well, considering the very explicit linkage management is now making between their big PRB operations and, national energy security, critical mineral supply, how should you actually value a coal company that is simultaneously trying to position itself as a strategic national asset? The old valuation models, the ones based purely on cyclical commodity prices, they might just not fully capture this potential new paradigm. It's something to think about.
That is a truly compelling thought to end on. Thank you for tuning into this deep dive. As always, we invite you to continue your own research and analysis. We'll talk to you next time.